Imagine a financial creature so large it dwarfs the GDP of every country on Earth. A creature that moves money faster than any bank, any government, any central authority. A creature so deeply woven into the world economy that if it ever stopped breathing, the entire global system would suffocate within days. But here's the twist. This creature doesn't officially exist. We call it the shadow banking system. But the name is misleading. It's not a secret crime ring. It's not a dark alley full of loan sharks. It's not even a place. It's a network, a process, a shape-shifting ecosystem of financial entities that act like banks without being regulated like banks. And the number attached to it is staggering. $100 trillion. More money than the entire global stock market. More money than every government budget combined. More money than most people can even conceptualize. Yet you never see it. You never touch it. You never hear news anchors explain it. But your mortgage, your job, your currency, your investments, every one of them depends on this invisible system functioning perfectly. Why talk about this now? Because the world economy is shifting. Interest rates rising, debt levels exploding, liquidity tightening. And in this kind of environment, the shadow system starts to strain. When it strains, markets shake. When markets shake, governments panic. When governments panic, ordinary people suffer the consequences. So let's start at the beginning, not with charts or jargon, but with a simple, quiet question. What makes something a bank? A bank takes deposits. A bank gives loans. A bank moves money. A bank creates credit. Now here's the uncomfortable part. Millions of financial institutions do all four of those things, without ever calling themselves banks. They don't have branches. They don't have depositors like you. They don't operate under the same laws. They don't have strict capital requirements. And when they fail, there is no emergency rescue plan built for them. They are too invisible to regulate, yet too essential to ignore. Let's simplify it. A shadow bank is any entity that behaves like a bank but isn't regulated as one. Hedge funds, money market funds, private credit firms, securitization vehicles, mortgage trusts, fintech lenders, insurance giants acting like investment banks, corporations acting like lenders, even investment funds you may unknowingly hold in your retirement account. Individually, they look harmless. Collectively, they make up the largest financial ecosystem in human history. So how did we get here? To understand that, we go back several decades. Traditional banks were heavily regulated. They were told, keep more capital, take fewer risks, follow stricter rules, be transparent. And guess what happened? Risk didn't disappear. It migrated. It slipped through cracks. It reinvented itself. It reassembled into new forms. Imagine trying to squeeze a balloon on one side. It doesn't vanish. It simply expands somewhere else. That somewhere else became the shadow banking system. It grew in the background, quietly, efficiently, silently. And because it operated outside the tight constraints of regulated banking, money could move faster, cheaper, and with far more leverage. Leverage is the key word here. Because leverage is the heartbeat of shadow banking. In the traditional banking world, leverage is controlled. Banks must maintain reserves. They must keep capital buffers. They must undergo stress tests. In the shadow world, leverage is fluid. $1 of real money can be stretched into $10, $20, even $30 of credit. And credit is oxygen. It fuels markets. It fuels companies. It fuels governments. It fuels the illusion of stability. But stretching $1 into 30 creates fragility. The system becomes sensitive to shocks, to rumors, to liquidity freezes, to sudden demands for repayment. So how does shadow banking actually work? Let's walk through it step by step, Imagine a large investment fund needs short-term cash. It doesn't go to a bank. It goes to another fund. That fund borrows from a different financial pool. That pool borrows from a corporate lender. That lender borrows from a short-term market. And this chain continues, one entity lending to another, each layer adding risk and leverage, each transaction generating fees. Nobody holds the full picture. Each participant sees only the link directly in front of them. The system feels stable until one borrower fails. Then the entire chain begins to tremble. This is the hidden mechanism that terrifies regulators: contagion. One institution's inability to repay becomes another institution's liquidity crisis, which becomes another institution's forced selling, which triggers market panic, which triggers more forced selling. This is the financial equivalent of a forest fire. It spreads too fast for anyone to contain. And here's the reveal: the uncomfortable math. The $100 trillion shadow system isn't backed by $100 trillion of real assets. It's backed by a fraction, a thin layer of actual cash supporting a massive tower of obligations. It's a skyscraper built on a matchbox. Yet governments depend on it. Corporations depend on it. Banks depend on it. Investors depend on it. In fact, shadow banks now hold a massive amount of government bonds, meaning governments rely on an unregulated network to stay solvent. If shadow lenders ever stop buying or suddenly sell, credit markets freeze. Bond yields spike. Currencies wobble. Economies slow. This isn't a theory. It already happened. In 1998, in 2008, in 2020. Each crisis revealed the same truth. Shadow banks amplify everything. They magnify profits in good times, and they magnify losses in bad times. So why don't regulators shut the system down? Because they can't. Shadow banking is everywhere, interconnected, global, fast-moving, and governments are now addicted to it. Imagine a doctor discovering that the only thing keeping a patient alive is the very drug that is slowly killing them. Do you stop the drug, reduce the dose, increase it, or hope nothing goes wrong? This is the situation regulators face. The world economy relies on a system it cannot fully control or fully understand. And here's where irony enters the story. Whenever regulators tighten rules on traditional banks, shadow banks grow faster. Whenever central banks pump money into markets, shadow banks expand. Whenever investors demand higher returns, shadow banks innovate new products. Risk doesn't vanish. It simply hides better. Let's widen the lens. What are the long-term risks? First, liquidity risk. Shadow banks depend on short-term borrowing to fund long-term assets. If short-term lenders panic, the entire structure collapses. Second, opacity. Nobody knows where the risks are concentrated. Not governments, not central banks, not even the participants inside the system. Third, incentives. Shadow banks earn profits by taking risks. The more risk, the more profit. But when things go wrong, there is no backstop. Losses spread into the real economy. Fourth, scale. The system is too large, too vast, too global. If it implodes, central banks may not be able to rescue it.